Hello, and thank you for joining us today for this seminar presented by ARTA's Pension and Financial Wellness Committee. We're pleased to offer a series of financial wellness seminars throughout the year to create an opportunity for education on topics specific to retiree financial wellness. Since ARTA was formed in 1963, we focused on supporting our members in an engaged and active lifestyle in retirement. Our holistic approach includes one of the best benefit plans in the country, as well as many additional programs and services, including our ARTA Perks discount program, physical wellness events, social opportunities offered through our regional branch, scholarships for family members, and of course, seminars just like this one. ARTA also serves as an advocate for teachers and retirees, using our collective voice to draw attention to the ATRF and teachers' pensions, the seniors' drug plan, and most recently, the impacts being felt in healthcare in rural communities. Many different factors allow ARTA to maintain such a wide reach, but in the end, because we were created by retired teachers, for retired teachers and like-minded professionals, we remain dedicated to retirees. With that, I'll pass things off to the outgoing chair of ARTA's Pension and Financial Wellness Committee, Ray Hoger.
Welcome, everyone. My name is Ray Hoger, and I am the newly elected Vice President of ARTA. I'm joined today by one committee member, Lara Lowry, and by our ARTA's Treasurer, Lawrence Ryken. As you may have noticed, we have disabled attendee video and audio capability. This will help ensure a quality experience for all participants by limiting web streaming. It also allows us to record this webinar without breaching your privacy. With your audio muted, we encourage you to use the Q&A feature found at the bottom of your screen to submit your questions. You can submit questions publicly so that all attendees can see them, or you may submit them privately so that only the ARTA staff will be able to see them. Our team or the speaker will respond to the questions at the end of the webinar. A reminder for participants that this presentation is for informational purposes only and should not be used to replace a consultation with a trained legal, tax, or financial professional. Please contact a professional for financial, tax, or legal advice related to your special circumstances. With those housekeeping matters completed, ARTA is pleased to present today's session, an informative presentation on retirement planning and the impact of inflation. This webinar is more than just a market update. It's about planning for your future. Your concerns will be addressed, and insights will be provided into pensions, government benefits, and decumulation strategies, empowering you to make informed, confident decisions. I would like to welcome today's speakers, Senior Financial Advisor Renee Fearne and Specialized Wealth Planner Raymond Letendre from ATB Wealth. Renee Fearne is an Edmonton-based senior financial advisor with 15 years of experience in the banking industry. She has a Bachelor of Management degree and a Certified Financial Planner designation. She prides herself on being reliable, real, and building trustworthy connections with all of her clients. Raymond Letendre is a Chartered Professional Accountant, Certified Financial Planner, and holds a degree in accounting and business management. He is passionate about financial empowerment and helping clients navigate wealth strategies. He is an active participant with the Chartered Professional Accountants Tax Clinic and Financial Literacy programs, and was featured on the Financial Management podcast Straight from the CPA's Mouth, where he shared his expertise on effective money management. Renee and Raymond, the screens are yours.
So thank you, everyone, for being here today. We're very excited to put on this presentation for you. And just a reminder, all the content that we're going to be going through today will be very general in nature. And it's not to be taken as specific investment advice, so consult any financial, legal, or tax professionals that you may be working with. Today is just for informational purposes. So just a quick land acknowledgement here. We acknowledge that the land on which we gather is the traditional territory of the Treaty 6, 7, and 8 nations of Alberta, and acknowledge Treaty 4 and 10. We acknowledge the ancestral territory of the Cree, the Dene, the Blackfoot, the Stoney Nakoda, the Saulteaux, the Ojibwe, the Tsuut'ina, and the homeland of the Métis people. We acknowledge that the original signatories of these treaties agreed to its terms so our people could create a relationship and move forward together in a peaceful way. We acknowledge the land is an act of reconciliation that honors the authentic history of Turtle Island and the original people of the territory. So, as Ray mentioned, my name is Renee Fearne. I'm a senior financial advisor here with ATB Wealth. I've been with ATB now for just over 15 years. I hold a certified financial planner designation. My role here is to work with clients from a range of different financial backgrounds on a variety of different financial solutions. So some areas we might focus on could be basic budgeting and cash flow, and then mostly with a heavy focus around investment solutions, retirement, estate, and tax planning. And so I'll pass it quickly over to Raymond to do a little bit about him.
All right, thanks, Renee. As Ray has already introduced me, my name is Raymond Letendre. I work in a support role to our advisors at ATB Wealth, in that I don't manage clients directly myself. I work in the background to provide specialized wealth planning services to our valued clients. And so with that, we do a lot of tax planning, cash flow, budget management, and as we'll talk about in a few minutes, what I call the quintessential question is to how do I access my money? What is a good decumulation strategy, and how do I put it all together with tax savings in mind? So we'll look at all those details. As Ray mentioned, I'm passionate about these topics, and so hopefully you get something useful out of today's content.
So we are here today on behalf of ATB Wealth, which is the wealth management arm of ATB Financial. And ATB Wealth comprises of ATB Securities Inc., ATB Investment Management, and also our private banking group. And together we provide a wide range of financial services and advice to Albertans. Both Ray and I will be discussing various topics today, such as inflation and how that ties into your pensions and your government benefits. We will discuss the benefits of working with an advisor on a financial plan, and then a little bit about how we might approach investment solutions specifically around inflation. Over the past year, as you are all likely aware, inflation has become an increasingly popular topic of conversation, and it's a very key consideration when it comes to planning for any long-term goals like retirement or a major purchase. So as part of this presentation, we're going to begin with an understanding of what inflation is. And so inflation, put simply, is the general increase in prices. It is the basic premise that the same amount of money in your pocket buys less and less over time. So when planning for future purchases and expenses, inflation often takes a little bit of a backseat to other topics, such as perhaps planned savings or your investment returns, fees, debt, that kind of thing. There's a reason why it doesn't stand out, and that reason is because it doesn't show up on a bill or a statement, and it actually takes effort to identify it. So let's consider an example of just an everyday grocery item. So based on the most recent data, which is 2022, a loaf of bread costs $3 per loaf. So if we have a $1,000 grocery budget at $3 a loaf, you're able to purchase 333 loaves of bread. Now, if we fast forward 20 years from now, we have the same $1,000, except now that loaf of bread costs $4.46. So your purchasing power has actually decreased from 333 loaves of bread down to 224, excuse me. So now you can only actually purchase 2/3 of what you could 20 years ago. This is that loss in purchasing power, and it applies to all goods and services. So from a financial planning perspective, as mentioned earlier, Ray, just go back to the last slide real quick.
Sure.
Let's assume that we need $80,000 a year to retire comfortably, and you need to fund that entirely with savings. So there's no pension or other factors. You need $80,000 from your savings. So what you would do is you're going to add up 80,000 times 30 years, and then you're going to assume that you need 2.4 million to retire. However, when you actually factor in inflation, as you can see here, you need substantially more than 2.4 million. In fact, you need close to 3.3 million. So you can also see from this graph as well that the impact of inflation becomes more pronounced as we look over longer periods of time. So neglecting inflation when we're planning for our future could lead to significant failures in our overall financial plan. So let's look now at how a net worth of $1 million can change over 30 years when we take into account inflation. On the left-hand side, we assume no growth on your net worth. And as you can see, your situation remains very consistent. It looks quite nice. However, once we compare it to purchasing power and we factor in inflation on the right-hand side, you can see that your purchasing power is declining over time, and almost to the point where after a 30-year period, your purchasing power is cut in half. So your net worth remains the same. However, the erosion of purchasing power is significantly impacting your future lifestyle. Now, if we use that same example, except let's assume that we invest that $1 million and we earn 2.5% growth annually. On the left-hand side, your net worth appears to be increasing quite rapidly. However, once we compare it to the graph on the right, we see that your growth in purchasing power is not happening nearly as rapidly as we thought. You're basically only preserving your purchasing power at this point rather than significantly increasing it. So understanding the impact of these scenarios will be really important when it comes to retirement planning and when it comes to determining a realistic budget. What your investment advisor would do, which is something we often do in investment planning, is we adjust returns for inflation. So this is referred to as the real rate of return, and planning around that real rate of return can help limit the risk of unexpectedly running into scenarios such as these. Next slide. So just some data here on inflation, as there is no doubt that inflation is a major concern for many, many Canadians right now. So despite seeing inflation coming down in 2024 and central banks around the world decreasing their overnight lending rates, inflation is still a very real and valid concern. So the Alberta inflation rate in 2021 was 3.2%. And then we saw headline inflation in March of this year of 6.5%. Alberta's inflation rate does remain higher when compared to other provinces in Canada, partially due to increased housing costs from an influx in the population here. Then in terms of Canadian inflation, the Bank of Canada's target is still 2%, and so within a control range of 1 to 3%. And then in September, we saw inflation sitting around 1.6, and then the Bank of Canada reduced their overnight lending rate last week by 50 basis points. I will turn it over now to Ray to discuss some pensions.
All right, thanks, Renee. So as Renee mentioned, obviously this focal point of this presentation is around inflation and planning for your retirement. And of course, I believe everyone on this call is a member of the Alberta Teachers Retirement Fund. So very specific to our discussion today is how you incorporate your pension into your retirement planning. So just a little bit of background on pensions and the ATRF, as you all probably know better than I do. The ATRF pension is a good pension that's available to you in your retirement. It's a defined benefit plan, and defined benefit plans are not very as common today as they once were. They're an excellent source of income that's intended to last your lifetime, really. Many pensions have an indexing feature that will increase the amount you receive each year based on changes to an inflation benchmark, often measured by changes in the Consumer Price Index. And specifically, the ATRF is adjusted to the Alberta Consumer Price Index. Pensions rarely keep pace with inflation, though, over the long term. Not all pensions are adjusted the same way. So what does this mean for you? It means the difference generated needs, the difference in inflation and your spending needs needs to be generated from personal savings. So in the ATRF's case, the adjustment is 60 to 70% of the Alberta Consumer Price Index, 60% for service before December of 1992, 70% thereafter. So you may or may not be familiar with a lot of the details of your ATRF pension. So we'll talk. What we're going to talk about today is generally terms around your pension, but how you incorporate that into your retirement planning, because pensions, for a lot of people, may only provide a portion of the income that's necessary. Okay. So as mentioned, the HRF is adjusted by the Alberta Consumer Price Index. And from your website, it can be noted that this is meant to reflect the cost in shelter, transportation, food, recreation, basically expenses that are real and common to the Albertan consumer. So when you retire, you may not have to travel to work as much, but you're still going to spend money on groceries, gasoline, and what have you. So the Alberta Consumer Price Index measures the price of the changes of goods and services by Alberta consumers by comparing the cost over a certain period of time. This is also referred to as a cost of living adjustment, or a COLA, if you will. This year, January, the ACPI was 3.9%. And so your adjustment is 60 or 70% accordingly. And your pension would be adjusted each January. So that's as much as I'll talk about the ATRF specific pension. I'm sure there's many other people on this call that are better experts on the details than I am. But we will talk about how you incorporate your pension income, which is a very attractive and lucrative benefit as a retiree, because you have that guaranteed source of pension income through your lifetime, and it has a pension or an inflation adjustment. Some other benefits that you will have as a retiree, we call it the Canada Pension Plan, but it's not from an employer, obviously, it's from the government. So similar to your ATRF, you would have paid into the Canada Pension Plan over time. And some of you will absolutely be expecting some Canada pension benefits. We often hear, though, from clients that they don't believe the Canada pension will be there for them in their retirement, which I would vehemently say that I'm confident that it's not only going to be there for you and me, but Renee and her children, and I think it's very well funded. And in fact, they've done studies. There was actually Canada pension reform a number of years ago, where the investment approach that the Canada Pension Plan took was changed. And in fact, there's triennial studies on the viability, the current status, and what we find, or what we found just from recent inquiries, is that it's very well funded. And in fact, they do a viability study. And as of the last triennial report, the CPP is sustainable over the next 75-year period. And in my opinion, I think it's sustainable even beyond that. Okay. So talking a bit about Canada Pension, because when we do planning, and you'll notice today's conversation is a lot, we'll use the term planning a lot, because really everyone's individual specific situation is specific to them. So some of you as retirees may have a large pension benefit, or some may have a lower pension benefit. Therefore, you have different amounts of retirement savings through registered accounts and or TFSAs or registered non-registered accounts. So we'll talk a little bit later about how we wrap that together, and it really depends. But when we start as a foundational level of income, obviously your ATRF is going to be a foundational level of income for you in retirement. But Canada Pension is also a foundational level of income. And if you haven't received or requested a statement of your benefits, I would really encourage you to do so. You can actually just go online, call Service Canada. There's a 1-800 number available. And what they'll do is they'll send you a statement that looks something like this. And in my opinion, I mean, I won't get on my soapbox today, but I've got a lot to say about Canada Pension. One of them is that the statements that they provide are not necessarily the most helpful. What it'll look like is, let's just say you're 50 years old today. You'll get a statement that looks, literally, this is the wording. Maybe these aren't your numbers, but I just use these numbers as an easy example. It'll say, despite the fact that you're 50 years old today, for example, at 60, you could receive, at 65, or at 70, you could receive. So you think to yourself, well, that's not really helpful because I'm not 60, 65, or 70 today. Going one step further, neither nor are these numbers correct when you actually are 60, 65, or 70, because it's a statement snapshot as of the date of the statement that's provided. Okay, so if you get something like this and it says, for example, $1,000 at 65, I've got a little asterisk there because that's the number you want to look at. As of, going forward to 2025, the maximum CPP monthly benefit that you can earn is about $1,364. What the statement is telling you is that to date, from age 18, you have acquired 1,000 of 13/64, i.e. 73%, of the pension credit in your working history. And because it's based on your working history, this number is subject to change. So if you get this, the statement again next year, or at 60 or 65 as a 50-year-old, these numbers will change depending on whether or not you've continued to pay into the plan. So I would always encourage you, they're free statements. So you can go online, check your entitlement anytime, or call for a free estimate anytime. The important thing to note here, though, is that as it indicates, you'll notice that these numbers are indicated at 60, 65, and 70. If you take Canada Pension at age 60, it's reduced by 0.6% for every month before your age 65th birthday. So 60 is 60 months before age 65, 5 years. So it's reduced by 0.6% times 60 months, i.e. 36% reduction. I'm not a fan of having my money penalized from the government. So I'm inclined to normally recommend to clients that you don't take it before age 60. So we'll talk about that a bit more in a second here. Likewise, if you delay your Canada Pension benefit, you'll actually get a benefit. A flat benefit, we'll talk more about this, of at least 42%. But in fact, it actually works out a little bit more than that. So getting into the example here, there's a couple, I tried to keep this slide as straightforward as possible. But what's happening is if you take Canada Pension before age 65, again, it's reduced by 0.6% per month that you take it early from your 65th birthday. But it's not just the 36%, because if you take it early, you've locked yourself in now for life. You will get the inflation adjustments every year. So if you take it at age 60, it's going to increase a little bit every year. But now you've locked in that amount, and you're not eligible to what your unreduced amount would be later on. And so by locking in that amount, you are no longer going to benefit from the actuarial, i.e. inflation increases that would be available, say, if you did take it at 65. So in fact, if you did take it at age 60 by comparison, it's not just a 36% reduction, but again, you're giving up that adjustment that it would have been inflated to at age 65. So it's actually closer to about a 39% reduction, give or take, depending on what inflation and adjustments are. Likewise, at age 65, it is what it is based on your entitlement at that time. There's no reduction or bonus. After age 65, you get a bonus of 0.7% per month after your 65th birthday. So 60 months to age 70, so 5 years, that's 60 months times 0.7, that's a 42% increase if you wait until age 70. So again, it works the same way, that not only are you getting that 42% increase, but you're getting a 42% increase on the amount at that time, okay? So not only are you getting the increase based on delaying it, but you're getting a bonus on top of an increased amount, if that makes sense. So again, this is part of my soapbox that I was getting into discussing with Canada Pension, because it pains me to see statistics like this that show, we just look on the left side, what we see here is that roughly, as of 2019, the percentage of people eligible for Canada Pension who take it at age 60 is roughly, let's call it 25, 30%. And that's because, and this is a bit of a sticking point with me, because you get a letter in the mail from the government that says, basically, hey, would you like free money from us? And it's not free money, it's your pension. And normally people aren't going to say no to that. So without knowing what the background is, because they don't tell you that you're going to get penalized. They say you're eligible for your pension. And generally people are inclined to say, yes, I will take money from the government if they're offering it to me. And what we see is that not a lot of people take it before, 61, 62, 63. At age 65, it spikes up again, because that's when a lot of people maybe tend to retire. And so it becomes a very popular time to take it. And as you can see, very, very, very few people actually delay it with a bonus. Now, actually, my next screen here talks about, so what is the correct answer? The correct answer, unfortunately, is it depends. And I always like to say, though, that not to leave you hanging, it's a qualitative and a quantitative decision. Quantitatively, mathematically speaking, we can do the finances, and we have, that you will be better off financially speaking if you at least delay your Canada Pension until 65, or even delay it until after your age 65th birthday. Qualitatively, though, and the math is based on having a long lifespan. So qualitatively, if you have a shortened lifespan or shortened life expectancy, then it can make sense to take it earlier. We have clients that say, I don't care if I'm better off financially, I just want my money. That's a qualitative decision. If you can't afford your lifestyle, well, that's a qualitative factor too. I mean, if you've got expenses and you need to rely on kind of pension, then that's a decision too. Just know though, the takeaway with this is that if you do decide to take it early, it will be penalized. And all things equal, if you have, call it a normal a statistical life expectancy of age, say 82, 85 in that area, then it is financially better off if you delay it, at least until age 65. Okay. The other Canada government benefit is old age security. Now, unlike Canada Pension, where it's based on your earnings history, old age security is going to be available to you, provided that you've lived in Canada at least 10 years after age 18, and you'll get full old age security eligibility if you've lived in Canada for at least 40 years after age 18. And so the reason why I say you'll be eligible for it is because old age security is income tested, i.e., if you make too much tax net income in retirement, then old age security may tend to be clawed back, i.e., you'll have to pay back some of it. It's quite generous, though, in my opinion, because old age security is intended as a supplement, and what it's there for, or when you factor it in, if you make too much net income on your tax return, then the amount, and it's quite generous, you're allowed about $90,000 of net income. The amount that you make in excess of that, then the old age security benefit that you receive will just have to be repaid at the amount of 15% of the benefit above the amount that you're above 90,000. I know it's a little bit convoluted of an explanation, but the fact is that if you can and you want to try to manage your old age security eligibility, then try to manage your net income $90,000 or less. That $90,000 threshold increases every year. But again, it's not the end of the world if you make $91,000. In fact, you only pay back a little bit of old age security. You can make up to about $140,000 plus of net income before all of your old age security is completely clawed back. So, in my opinion, it's quite generous. Okay, so we already talked about this. The one thing I didn't mention, though, with old age security is that, in addition, you can take it before age 65, but if you delay it after age 65, it's not as lucrative of a bonus when you, compared to Canada Pension, but there is a 0.6% per month bonus if you delayed it after age 65. So that's a planning factor where, depending on what your income is when you retire, it may or may not make sense to take Canada Pension, old age security at a given time. And really, when I say it depends, it really is going to come out in a plan analysis for you. So if you work with an advisor, then you are encouraged. Most banks, financial advisors will offer some type of planning analysis. So I'd encourage you to talk to someone, see if they can do a planning analysis or a fulsome plan for you to see what the impact is going to be for you. So I'll turn it over to Renee then to talk more about wealth planning and how investing works into your plan.
Yeah, thanks, Ray. So I think that was kind of the perfect segue into the wealth planning process and why we feel it is so important to have a detailed financial plan. So long-term wealth planning considers goals for your entire lifetime, and then also incorporates long-term planning for family wealth. So in your pre-retirement years, this is what we would consider the accumulation phase. This phase is generally during your working years where you're actively saving for retirement and other financial goals. This is generally when we're seeing our net worth grow. Then we shift into the retirement phase, or what we often might call the decumulation phase. You worked really, really hard in pre-retirement to at least maintain your lifestyle. Therefore, the key here in this phase is to maintain or grow that purchasing power over time, which will require income growth to keep up with spending and to offset the impact of inflation. And then once we move out of the retirement or the decumulation phase, we head into that wealth transition. So here is really where your advisor will take into account your legacy goals. So what do you wish to leave behind for your children, your grandchildren? What do you wish to donate to charities? Or perhaps, quite simply, your goal could be spending all of your money before you die. So when we're building your financial plan, or what we might also call your lifestyle plan, we are taking into account all of these 6 different areas. This is also called holistic wealth planning. So it brings together all of these 6 different components into one place. Your advisor will help encompass each one of these areas, but they'll also take into account some more human elements, such as your emotions, your values, and your beliefs, which are also a key consideration when putting together your financial plan. This process also doesn't just involve you and your financial planner. This might also include people such as accountants, lawyers, maybe your investment advisor is separate from your planner, could be your banker, your insurance advisor, etc. So there's some really interesting data here on Canadians who work with financial advisors and those who don't. The role of your financial advisor is to work with you to build a plan to meet your unique and very specific goals. So they offer comprehensive guidance across all aspects of your finances. This can include building out long-term investment plans, implementing tax strategies to help meet your goals. They also generally have a very deep understanding of what's happening in the market and the economy, and they're able to assess how those changes might impact your portfolio and your plan. And we kind of consider them to be, a guide, and a guide that's alongside you through a lot of life's events. So as your life and as your situation change, your advisor is there to help make the appropriate adjustments to your plan. And what we consider very, very important here is trust. Trusting your advisor and having a really solid relationship with your advisor is going to be key in the overall success of your financial plan. So now if we specifically speak to inflation, the most important thing, and you'll notice this is a theme throughout this entire presentation, is having a plan. So your plan acts as a roadmap. It shows you where you are and where you're going. And oftentimes without that roadmap, you are lost. So, and in addition to that, another really important factor when we're building our plan is being extremely accurate when it comes to building out your budget. So one of the main reasons why we often see plans fail is because we're not budgeting adequately. So it's important to be very clear on what our expectations are versus reality, and then also be able to plan for those unexpected costs. Your advisor will also wish to revisit your plan and all the projections that you make regularly, at minimum annually, with you. And then lastly, to combat inflation, your investments need to at least be generating a rate of return that's at least at the rate of inflation, if not higher. I'll kick it back over to Ray to discuss some cash flow and decumulation strategies.
All right, thanks, Renee. Yeah, and so on just touching on that, the topic a little bit about keeping tabs of your cash flow and budgeting. I know budgeting sounds like a bit of a restrictive word. I can only spend so much. It's not necessarily about restricting you, but it's really about knowing what it is that you need. So when we do analysis to show you what's required for retirement, it's going to look at, well, what do you have? Where is it? But what do you need? Somebody who has $1 million in the bank account and spends $1 a month, as an extreme example, I could probably say is going to be okay. I mean, that's obviously a silly example, but really that's kind of the formula, if you will, is what do you have and how does that compare to what you need? As we mentioned before, what's going to happen is you'll have a foundational level of income through pensions and government benefits, perhaps. You may have other savings, non-registered TFSA, registered savings plans. So how does that all factor in? So this is what I often say is the quintessential question when we speak with clients. So if we can show you some examples here, I'm going to go over a few slides of an actual live client plan analysis that I've done recently. And the question is always, again, I've got my foundational level of income. What do I take? Where do I take it from? What, where, why, when, and how? And that's what we aim to address. So decumulation, I'm not sure if that actually that word is in the dictionary, but we refer to that term a lot in terms of it may not necessarily always mean how do I wind down my assets to zero, but it's more about, like Renee mentioned previously, you've accumulated and worked hard all your life. Now we're looking to decumulate, i.e. create yourself some income in retirement. So how do we do that? Well, you're going to have taxable income from your pension. Most of you, I think, in this call will have that. You may have Canada Pension, Old Age Security. Those are taxable foundational levels of income. You may have investment income, dividends, interest, and capital gains from your non-registered investments. But aside from the income that you're generating, the other side of creating cash for yourself is if you've got money in your bank account, or simpler yet, if you've just got money in your wallet and you go to the store, taking the money out of your wallet and buying groceries, that doesn't create a taxable impact, right? But if you first take money out of your RSP, put it in your bank account to go and take it out to go to the store to buy groceries, taking it out of your RSP creates a taxable impact. So that's the concept here is creating cash flow for required spending needs to be a function as to what your required spending is. So for example, back on that point, when we want to know what your needs are for lifestyle spending, we wouldn't take out we wouldn't recommend taking out $100,000 from your RSP when you only need to spend 20, right? And now in retirement, you want to try to be tax efficient and be cognizant of what your requirements are. Okay, so just as a reference point, taxable income, again, depends on the source, pension, registered savings, government benefits. If it's non-registered, like a bank account or a non-RSP account, generating stocks, generating dividends and whatnot, that will be taxable accordingly. So generally, interest is the least tax favorable in a non-registered account, and then dividends, and then capital gains. Subject to the recent tax changes of $250,000 and above, but we'll not get into that here. So really managing tax will be a function of creating your own specific retirement paycheck, that we like to call it. And so when I work with clients, and when we work with clients, Renee and I, we'll often look to see, okay, well, what do you have available to you? What do you need? What's the gap? And so how do we fill that gap? And that's going to be a big part of the analysis. And that's what we like to call the retirement paycheck. How does it all come together? So now for this client, this client didn't actually have a pension, but it just worked out really well for the illustrations. So for this client, what we showed this retirement paycheck as is a function of government benefits eventually. Now this client, off the top of my head, I believe they're approaching 60 years old and they wanted to retire within 5 years, I believe it was. So in retirement, when we stack all the foundational income plus their savings and pension and whatnot, if this client had a pension, it would just be another bar as part of the chart here. So you would have your government benefits eventually, and your minimum RSP or registered income withdrawals, maybe TFSA withdrawals, some non-registered withdrawals, and other is maybe could be a part-time job or some other income that's available to you. So what we did now, in itself, this graph doesn't really say much, but as part of the analysis, we did discover that by doing this, it made sense for this client to take some registered income early. And we're going to see how that quantifiably and tangibly made sense for this client, because some people, I won't say all, but when you retire, it's a bit of a mind shift. And as Renee mentioned earlier, there's some psychology that needs to come into play when you change your mindset from working hard and accumulating funds to now you're retired and you need to spend your money. I'm here to tell you, spending your money is okay, and paying taxes is okay as long as we can manage that, right? So for this client, we took some registered income early, which did cause some increased taxable income for them, which increased their tax payable in the short term. But what we do in our analysis is see how that impacts your finances over the long term. Okay, so this is specific to this one analysis, but really it can be a combination of various items. Maybe you take your registered income earlier, maybe you defer it until later because you've got a large pension income now, or maybe you don't have a lot of RSP income because you've been contributing to your pension for so many years. It really does depend. So in this case, the client actually had more significant registered savings than anything else. So in this case, after the analysis where we showed this is how you will provide income and cash flow for yourself, this was the result. Now, they were intended to retire, I believe it was 2029. And so what we see here, I try to keep this very specific. The dark blue is without any planning. If we just simply try to minimize taxes in the short term and didn't have a planned approach, you can see the dark line is the taxes that would have been paid over the long term. And you can kind of see in the latter years, it's quite significant compared to the recommended approach. The light blue line, what we see here is if you just pay attention to the light blue line, what we see here is that at retirement, without doing anything, if the approach was to say, you know what, I'm scared to take out money from my RRSP because it's going to create taxable income for myself. And we just relied on low amounts of taxable income and didn't plan for the future. We do see that the dark blue line is lower in the near term, okay, because we didn't plan, we didn't identify what the good, better approach was by doing nothing, if you will, and just creating cash flow otherwise and trying to save taxes in the near term. What that did for this client was it meant that his RSP balances would grow and grow and grow. And at age 72, then he's faced with taking large RIF minimum withdrawals. And if you're familiar with RIF accounts, at age 72, you have to take out a minimum amount, whether you need to or not. So despite what I said earlier about not taking out more than you have to, at age 72, the government says, we need you to start winding down these balances. So by comparison, what we did for this client was we did actually increase his taxable income in the earlier years, which is a bit counterintuitive if you're just looking at the short term. But over the long term, what you see was we created some very stable long-term and by comparison, lower total taxes in his overall financial situation. Okay. There we go. Okay, so with that, again, my point to take away from that is that it's specific to your situation, and it's hard to say specifically what everyone should do. In fact, that's impossible without having an analysis done for yourself. So I'll pass it over to Renee to talk about good investment strategies in retirement.
Thank you, Ray. So I think the first thing that, and we've sort of touched on this throughout the presentation as well, but the first thing that we'd like to acknowledge here is that it can be really difficult shifting into retirement from years and years of working. It's a total mindset shift. You have saved and saved and saved. You've watched your net worth grow over time. And it can be quite challenging to now shifting into that mode where we're spending that money and maybe we're not seeing the net worth grow as much, or perhaps we're even seeing the net worth, your net worth come down over time. You could have concerns that you might run out of money. Perhaps your investment returns aren't what you expected. Perhaps you're worried that you won't leave as much of an inheritance for the next generation. So this is really where working with your advisor on that plan can alleviate some of these worries. So it's really, really important to share all those concerns with your advisor so they can present the information and the plan to you. So in retirement, we believe that there's sort of a unique set of risks that retirees face. So from an inflation perspective, we need to make sure that our financial plan considers inflation and is adjusting your needs accordingly. So this brings it back to those first couple slides. We need to be sure that our plan takes into account increasing salary needs over time. In addition to that, your investments really need to be positioned to, at minimum, keep up with inflation. And then from a budgeting standpoint, we've kind of mentioned, budgeting is always not so much fun, but it can be as simple or as detailed as you'd like it to be. But the more accurate it is, the better you will be able to cope with some unexpected expenses. When it comes to the plan, factoring in emergency funds and planning for unexpected events is going to be very important. Now, from a longevity perspective, FP Canada financial planning standards say we plan to age 95, and I can't tell you how many clients, they laugh at me in my office when I say, look, we're planning to age 95. But the reality is that Canadians are living longer, and we need to ensure the success of your plan long term. So, and this becomes increasingly important the earlier you retire as well, because then that's longer time horizon that we need income for. From an asset allocation perspective, we'll touch on this a little bit in the next couple of slides, but like we've mentioned, ensuring your portfolio will achieve all of your goals is very, very important. We also want to minimize risk in retirement. And then the key really here is to continue to revisit the plan with your advisor and make any changes that are necessary, and work with a tax advisor or an accountant, so we're not spending more on tax than we should be. So retirees face a very unique challenge. And so in retirement, what we really need to do is we need to be balancing the need to protect your life savings. So you've worked and worked and worked for all these years, you've saved up all this money, you've built up your net worth. So now you have this nest egg, and we want to, at the same time, protect it as well as grow it over time and be sure that we can keep up with inflation. So it's really, really common for retirees to believe that they should only invest during the accumulation phase or your working years. Sometimes they feel as if there's no more time or no more added income. I'm on a fixed pension, so I can't afford to invest and I can't afford to take risk. But the reality is that sometimes during this period, the investment plan is equally as important as it was during those working years. So balancing how your investment savings will contribute to your retirement goals is key. And so this is where we take into account your willingness versus an ability to accept risk. So how much risk you can take is very unique to you. It will depend on your investment time horizon, your liquidity needs, stability of some other income sources, your ability to adapt if things don't go as expected. Really, it's balancing investment needs and the ability to also sleep at night, which we consider to be very, very important. So we tend to avoid some volatility in retirement, which is normal. But oftentimes, if we're opting for things like cash and GICs, this strategy may end up neglecting your return needs, and it may not be keeping you ahead when we consider inflation long term. So on the next slide, this image illustrates how portfolios can be created using a mix of fixed income or bonds and equities or stocks. So on the bottom half of this slide here, it's really, really important to note that the account type does not determine risk or return, or it's simply, think of it like a bucket. And so that's the bucket that holds different types of investments. So you could have a GIC in your tax-free savings account, you could have a stock, a bond, or a portfolio, or you could have all of the above inside that bucket. What will determine your risk and your return will be what type of investment you choose. So depending on your specific and unique goals, your financial situation, and your capacity to accept risk, you could find yourself somewhere on this continuum at the top here. So for example, on the left-hand side, we look at a very conservative portfolio. You've got 75% invested in bonds, which tend to be a lower risk investment. And then you've got 25% invested in stocks. Right in the middle, a balanced portfolio would be 40% bonds and 60% equity. And then all the way on that right-hand side, perhaps, maybe when you were still building your net worth and still working, you were in a max growth portfolio, which is made up of 100% equity. So generally speaking, the more equity, the more stocks you have in a portfolio, the higher the volatility. And typically, the higher the volatility, the more of a return we're trying to achieve. So what we believe is very, very important here is balance. So using a diversified approach, a balanced approach, typically a small to mid allocation to stocks in a portfolio will help beat inflation, because corporate earnings tend to grow during inflationary periods as well. We also like to take a global approach where you're investing a little bit all over the world to reduce domestic inflation risk. But as we've said throughout the entire presentation here, the most important piece is to have a plan and have an investment strategy tailored to that plan, and one that you can hold through any market cycle. So just to tie this all together and to close off here, because I know we want to leave some time for questions. I love this term. It's called funded contentment, or the ability to underwrite a life that is meaningful to you. This was coined by Dr. David Portnoy from Shaping Wealth. And really what it is our goal, and any advisor's goal, is to help you build a plan that's going to help you achieve the life that you want to achieve. So we really, really enjoyed putting this presentation together. Thank you so much for listening. We'll pass it back to, I believe, to Ray or the facilitators, and hopefully we can answer any questions you have. And then if we can't, please feel free to reach out to either of us after the fact, and we'll be happy to chat with you.
Great. Thank you very much, Renee and Raymond. Right now I see two questions on the screen. The first one, what is your view, their theoretical question, what is your view of the Canada Pension Plan if the UCP forces a pullout for an Alberta pension plan? Do you see an APP as being in any way viable, sustainable, or beneficial?
Okay, I'll take this, Renee. So without, at the risk of sounding too political, which my wife tells me that I shouldn't, because we already have these conversations with our friends and they can be a little heated. But politics aside, I could be wrong about this, but I don't believe Alberta will pull out of the Canada Pension Plan. I think there's been a lot of lobbying and pressure placed. I think Danielle Smith, again, political opinion, is maybe wanted to just kind of push the federal government a little bit to say, you know what, we don't want to take it anymore, and we want to be in control of our own thing. Realistically, though, I mean, to answer the question, again, I don't believe it'll happen. If it did, though, there's all kinds of questions as to how much we are entitled to. Now, this is a whole other conversation, and there's a lot of academic discussion about this, as far as is it the amount we put in less what we've paid out, plus investment returns? Well, there's a host of reasons why that doesn't make sense. So what does make sense? And that's really where a lot of academia is caught up right now. Last I looked into it. But we could, as Danielle Smith and the proposal has been, is that we would at least want as much as we're entitled to, whatever that amount is. Might need to be yet to be determined. Again, my overall answer to that is I don't think it's going to happen. But if it did, Alberta has very competent investment managers, as HRF manages its own pensions. In Alberta, there's also the Alberta Investment Management Corporation, AIMCO, as you may have heard, that manages a lot of pensions. So we have very competent and capable investment managers here. But again, I don't think it's going to get to that point.
Thank you. Second question, how much is too much to pay for mutual fund advisors And are mutual funds better than GICs in retirement? When and how should you take them out?
So I will take that one. I don't like to have a general rule of thumb when it comes to paying for advice. It really, the reality is there's thousands and thousands of different mutual funds out there, thousands of different portfolios. The options are endless for what choices you have in terms of an investment. So, we'd have to be looking at, for example, I have clients that might pay upwards of 2.5% for a specific portfolio. However, that portfolio's long range rate of return over a 10-year period after fees have been deducted is 15%. So every portfolio is unique. Every portfolio is different. And so again, that will come down to what what have you built with your advisor, or what are you looking to build with your advisor? Generally speaking, you don't want to be paying more than you should in terms of investment management fees. But we also have to consider the fact that the more equity you have in a portfolio, the more costly it is to manage that portfolio. So that's maybe a general rule of thumb that you can have in your mind. If you've got a lot of bonds or fixed income in your fund, it tends to be on the more affordable side because there's less trading, there's less costs to manage that. Now, when we're comparing a portfolio to a GIC, we're talking two totally different investments. A GIC, it's guaranteed. You will get back what you put in plus a fixed interest rate over a certain time period. There's pros and cons to that. On one hand, there's that guarantee. But on the other hand, perhaps the interest rate, especially over a long term, it's not going to keep up with inflation, where a portfolio of investments will be designed to perform better than the inflation rate over a long term.
Okay, and that same question just clarified. When and how should you deregister your RSPs? I assume specifically when they're invested in mutual funds, but when would you want to deregister, or is number of options, I guess?
Yeah, this would go back to what Ray was talking about in the presentation. What we would look at whether it's a GIC or a mutual fund, doesn't really matter. At that time, we're looking at income. So we're looking at your pension, your sources of pension, your CPP, your private pensions that you have, OAS, those types of things. So that's when we can be a little bit more strategic about when we might start to take them out. I think Ray might want to jump in here.
Yeah, no, you said it, Renee, but I would just say that again, we talked before about what makes sense for different people. It really does depend. In this example, this client actually had almost exclusively registered savings and no pension and not a lot of other non-registered investments. So it made sense for this client to actually start deregistering or taking money from their RSP sooner than later. In a case where maybe it's the opposite, where you have a lot of pension income and as a result, maybe not a lot of, by comparison, registered savings investments, then it might make sense to delay that registered withdrawal until later on. Keep in mind that you have to start taking money out of your registered savings accounts by age 72. But really, when we think about the theme centric to this presentation around inflation and how you manage it, well, there's a saying in accounting and risk management, you can't eliminate risk, but you can reduce the cost of it. And I would say these tools are available to you. I'm looking back to Renee's slide here, but tools that are available to you are, you can decide what income, generally speaking, what your income and taxable amounts will be in a given year. With a good plan, you can decide how you're placing your money that you won't need for the long term. The long term being 5-10 years plus. And because retirement is a long time horizon, we do consider that 5 or 10 years plus. When we talk about risks, inflation, unexpected expenses, whatnot, that's really what we're kind of trying to say, is that the plan will identify when you should take the registered accounts out sooner or later, and determine if you have enough money. In some cases, we find that it's a big mixture of both. Maybe it makes sense to take out registered funds earlier than later, or later than earlier, or sometimes a combination thereof.
Okay. Another question, there is an age when CPP evens out no matter what age you start to collect. Do you have any idea what that age might be?
Yeah, so there's we've done math. There's actually a lot of academic studies on this, and so don't take my word for it. People smarter than me have concluded that, again, it makes sense if you delay it. But to answer the question, it depends on when you're which timeframes you're comparing. So generally, and I don't know the exact numbers and dates off the top of my head, but for example, if you're comparing taking it from age 65 or delaying it until age 70, that's a good question because, again, it depends. In it, just for example, a 65 to 70 example, if you take it at 65 or you delay until 70, well, we know that if you take it at age 65, then you'll have payments every month for 5 years, for 60 months, right? So after 5 years, taking it at age 65, you'll have, thousands and thousands of dollars of payments, obviously, right? Compared to if you'll wait until age 70, at age 70, if you've waited, you've received zero at that point, but you get more going forward. So the question, I think, is related to at what point, what's that break-even point, or when does it make sense? Well, the math in that example works out to, depending on who you ask and what variables you use, but it works out to about age 82, call it. Okay, so that's why we say if you have a long life expectancy, then delaying it can make sense financially. But again, if a client says, well, I'm 50 or 60 years old and I have 3 years to live, well, that's a qualitative conversation. So to answer the question, it's about that, age 83 on that comparison. I think on comparing age 60 to 65, it works out closer to about age, just over age 70 or so, where that you'll break even, and then you'll start to pull ahead. So we actually have some, if you actually, I think we have an article on this. If you just Google ATB pensions or Canada pension, we have an example, I believe, that shows what that sliding scale is. And if anyone's interested, they can reach out to me and we can provide that. But it is a sliding scale, a quantitative analysis, and that shows the impact.
Thank you. Defined contribution versus defined benefits, investment strategies to maximize funds accumulation prior to retirement. I'm not quite sure what they're asking for in that question.
Well, I'll just answer half of that, and then I can pass over to Renee, because the key difference between defined benefit and defined contribution is defined benefit is what the ATRF is. You make a contribution, you are calculated a benefit upon retirement, and it's paid to you, for life. Defined contribution is kind of the opposite, and those are more popular now. A defined benefit, the risk is on the ATRF to invest those funds and pay you out that money for life. A defined contribution, you're putting money into a pot of money, and you're investing it as appropriate, and I'll let Renee talk about that. But you're not buying yourself a future benefit guarantee. What you're doing is really just saving your money, and it's you would be investing it accordingly for retirement income later on. And whatever that income is going to be a function as to how you've invested it before that. So that's the difference between the two plans. But I'll let Renee share her thoughts on what might be appropriate for investing in a defined contribution plan.
Yeah, so like Ray mentioned, the defined contribution, you get a set amount from your employer. Generally, you put in the same amount as well, and then you sort of you're in the driver's seat, so you get to decide how that's being invested. Whereas not in the DB plan, it's just set. So I mean, again, very generally, what we tend to advise is that in the earlier years of your career, you can take on a bit more risk. So that's where you've got a really long time horizon. You're maybe still 20 years out from retirement. That's where we can have more, like I said, more stocks in that portfolio, be a little bit more stock heavy, a little less bond heavy. Cash certainly probably wouldn't be your choice if you've got a 20-year time horizon. A lot of times what the pension fund companies will do is they'll have do it myself feature or a do it for me feature. The do it for me feature is kind of nice when you don't really know what you're doing from an investment perspective, because what it will do is you'll tell the system what your ideal retirement ages. So let's say it's 65 and you're 45 now. It'll put you in potentially maybe like a target date fund where for the first 15 years or 10, 15 years, you're in something more aggressive. You got a more of a stock allocation in that portfolio. And then as you edge closer to retirement, it'll actually automatically reduce the risk of your portfolio, bring you to something that's a little bit more balanced. So tons of options. But again, that's maybe something that you want to chat with your advisor about if there's a particular plan and there's some options. I know that your advisor would be happy to review that with you. And if you don't have an advisor, we would love to.
Okay, and we'll squeak in one last question. For home care or assisted living care in old age, what would be an appropriate amount to budget for this type of care?
Well, I can share my opinions based on my experiences. I don't know if Renee has some clients who are experiencing something similar. It can really vary. If it's full assisted living, I'll say generally speaking, a few thousand to, I've heard as much as $7,000, $8,000, $9,000 a month. Maybe an unfortunate morbid reality though is that despite the high cost, they're generally short term. It's not for a long time. 20 years. It's usually 5 years or so in duration. So it can really vary depending on the level of care provided, as well as the facility. But not to be too biased, but I've heard that they can be somewhat costly because of that added assisted living benefit.
Yeah, I don't have a dollar figure. I mean, I kind of have a rough dollar figure just anecdotally based off of clients and what they're finding as they're taking that next step in life. All I can say is that it's really important to factor that into your plan. So a lot of times what people feel is, well, as I age, I'm going to spend less. So you can reduce my needs accordingly as I age. But the reality is that, yeah, we might be able to reduce it for a few years, but then, as life goes on and your medical needs increase, we would need to increase it thereafter. So I like to make sure that there is ample budget in those later years of life to cover off those costs.
All right.
Go ahead. Sorry, just one last thing that I'll mention here. And I actually just clicked on I just noticed there was a chat available mentioning that I was talking a little bit fast. I apologize. We're already 5-7 minutes, a little bit over, and I'm always guilty of that. So I apologize for trying to talk fast. But the other thing I would actually just say with regards to long-term care costs are that often what clients maybe forget is that what we see is there's often a lot of equity in a home. So you've paid off your home, and elderly clients are often sitting on hundreds of thousands of dollars worth of equity. Now, we don't necessarily advocate for always borrowing against your home, but we have seen in certain circumstances if care costs later in life become excessive, then the home equity is an option to offset that, just as a food for thought.
Okay. Well, thank you very much, Renee and Raymond, for presenting with us today. We'd like to thank all of our attendees for joining. We will be sending out a survey following this session. It will take less than 5 minutes to complete, and we value your feedback as we continue to plan for future pension and financial wellness webinars. I believe we can now say this will conclude our webinar for today, and everyone have a great day and happy Halloween.